The stock market has seen a return of volatility, and that has investors both anxious and nervous. But it's not something that we haven't been talking about on this channel and within my Discord community, the Stock Investor's Edge, as the headwinds are really starting to pile up. Although we did get some reprieve with the government shutdown supposedly coming to an end, at least for now. But there's other things to worry about. We have 30% of the S&P 500 that has its share price 20% lower from its 52-week highs. We're seeing labor force concerns, economic growth concerns, and the list goes on. But in today's video, we're going to be talking about 3 stocks that I believe it's time to buy the dip on. And all 3 of these stocks are high quality with huge futures moving forward, and that's why I'm going to be putting my money behind each of these names. And I'm going to unveil these 3 stocks right after the intro. But before we do, show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before I begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. So let's jump right back into today's video, and I'm not going to be making you wait for these 3 stocks. The 3 companies that I believe are great buy the dip candidates are going to be Duolingo, Meta Platforms, and the Home Depot. All high quality companies that are out of favor with investors right now, but that's what I love to find. High quality companies at great valuations. That is a long-term investor's dream. So let's look at these 3 stocks a little deeper, beginning with stock number 1, which is going to be Duolingo. Stock ticker DUOL. And Duolingo is a subscription-based learning platform. It started back in 2011 and is still led by one of their co-founders. The company recently reported earnings and the stock got absolutely crushed after the report, with the stock falling more than 25% on soft guidance. In fact, the company reported a double beat, with the Q3 EPS blowing away expectations and revenues beating the 11.4 million that analysts were looking for. But you have heard me say this before, it's less about the results and more about the guidance. When you and I invest in a stock today, it's great what they've done in the past, but our investment today is for the future. And I believe although investors are throwing out and slamming that sell button right now on Duolingo, it is presenting a huge opportunity for long-term patient investors. When it comes to Duolingo, the company currently has now a market cap of $9 billion, falling below the 10 billion threshold. And over the past 12 months, shares are down 40%, with all of that seemingly coming in the past few weeks alone. Wow, were things actually that bad? Well, as we just looked at a second ago, the earnings actually beat. The revenue results actually beat. It was all about the guidance. So let's take a look at that guidance first to see if that kind of drop was warranted. And as you can see here, the Q4 revenue guidance was in a range of 273 million to 277 million, with that midpoint being around 275. Analysts were looking for 274. Okay, so looking there, the Q4 guidance was actually above expectations. Now let's move over to the full year guidance, which came in a range of 1.028 billion and 1.032 billion, with a midpoint at, we'll call it 1.03. Analysts were looking for 1.02 billion. Okay, so looking there at the guidance, we looked at Q4 revenue guidance, we looked at full year revenue guidance, and both of those were ahead of expectations. So where was the guidance soft? Well, the problem lied in how efficient the business was being ran. And that's what I talk a lot about for those that take my 6-week investing accelerator program, how efficiency can be much more important than top-line revenue growth. And as you can see here, the EBITDA guidance ranged between 75.4 million and 78.8 million, which is well below the analyst's average estimate of $80.5 million. We are talking about a stock missing guidance, EBITDA guidance, by $3 million, and that resulted in a sell-off that shaved off $6 billion from the market cap just in the past few weeks alone. The CEO and co-founder stated that the company has been investing heavily, focusing more on growth, which will eventually lead to efficiency. The company has rolled out a slew of new AI features and more language courses with the help of AI. And as you can see from this fiscal AI chart, paid subscribers have grown from less than 1 million pre-pandemic to more than 11.5 million today. This reminds me a lot of the turbulence Spotify went through, a similar subscription-based model where the thought of music licensing was going to be dead in the water. But their subscription-based and their user base continued to climb higher and higher year in and year out. However, the stock price at the beginning of 2021 fell from the mid-360 range all the way down to $70 per share, a more than 80% decline in the stock price. But from that point forward, the end of 2022 to today, shares of Spotify have climbed more than 700%. Now, I'm not here claiming that Duolingo is going to climb 700% over the next few years, but it's giving you an idea. And at the same time, you could look at another subscription-based model that went through yet again another similar path in its early days, and that was Netflix. Looking here at the analyst estimates for the next year, analysts are looking for the company to generate 2026 EPS of $4.37 per share, which has been revised lower from $4.71 a few weeks ago after the earnings came out. But then they climbed back to $5.40 per share the following year. This puts the valuation at a forward PE multiple of 44 times and just 35 times 2027 estimates. This has been a very high multiple stock over the years with an average above 90 times. But growth for the next few years is expected to come in about 25%, so the stock is getting a re-rating. And looking here at the stock chart, you can see RSI is sitting around 20, which is typically a great indicator to buy a stock looking for a reversal. And if we zoom out even further from the end of 2022, Duolingo is trading at a key long-term support line, as the stock fell more than 40% from the start of 23 to mid-24 and now needs to hold the current level or risk falling to around $150 per share. And when it comes to analysts, they're still upbeat on the stock, giving it a 12-month price target of $280 per share, implying 45% upside from current levels. I think we could definitely see some more rockiness, some more volatility in shares of Duolingo, but entry points right around these levels seem like a great opportunity. And that's going to lead us to stock number 2, which is going to be Meta Platforms, stock ticker Meta. And although we're moving on to a different stock, this is yet another company that recently reported earnings that were better than expected. However, the guidance wasn't great, and the stock tanked to a degree of 10% after the report. As I mentioned, Meta shares reported just a few weeks back, and the stock fell nearly 10% after earnings. It had less to do with recent results and more to do with forward guidance. And as you can see, the earnings easily beat expectations of $6.69 per share, and top-line revenues of $51.2 billion beat out expectations of $49.4 billion. And looking here at guidance, the midpoint of the revenues beat expectations, but the CapEx spending was raised. The low end was raised, and this is what spooked investors. At first glance, this definitely gave me nightmares, and obviously it gave many investors reason for concern. But at the same time, the more I dove into the report, the more I became confident in Meta moving forward. I can't believe that they're going to go through a higher spending spree again, but it's going to be so focused. And yet again, we are seeing the results from prior spending. If a company was just spending aimlessly like they were pre-2022, we weren't seeing the results. Operating profits were falling. But what have we seen in the most recent years? We have seen higher spending, but at the same time, it's more focused spending. And that has led to not only higher profits, but higher operating margins. Looking here, you can see the dip in operating profits and operating margin in 2022. That was really the bottom. But since then, operating profits on their own are climbing higher and margins are trading at an all-time high. This is what prior year spending is doing for financial results. And when it comes to Meta, the company is one of the largest on the market today with a market cap of $1.6 trillion. Over the past 12 months, shares are positive by 8%, but that's obviously underperforming the greater market. And the stock is actually down more than 15% in the past week and a half since the earnings release. And when we look at valuation, you're getting a stock trading at a forward PE multiple of 21 times, which is slightly below historical averages. And the EV to EBITDA is right around historical averages. And that forward PE we just talked about is on 17% growth expected next year, giving the stock a PEG ratio of 1.2. When we take a look at this chart here, we can see the stock fell below its 200-day moving average and bounced at a gap fill area from back in May of this year. So that 605 level is proving to be a key support level. And if it breaks that, I'm looking around 575 for the next support. If you already have a sizable position in Meta, maybe you have the opportunity to be a little bit more patient given the greater volatility we have seen in the stock market as a whole here. However, if you have no exposure to the name, this appears like a great opportunity to at least nibble and build a starter position that you can dollar cost average into over time. When it comes to analysts, they're not shying away from the stock as they have an average 12-month price target of $849 per share, implying 34% upside from current level as they rate the stock a strong buy. And that leads us to stock number 3, which is going to be the Home Depot, stock ticker HD. And when it comes to Home Depot, there's a lot to like. First off, they operate in a duopoly with their closest competitor, that is Lowe's. And they have done a great job, a fantastic job, in fact, of fending off many online retailers like Amazon. And one way they've done that is with their buy online, pick up in store lockers. When it comes to the company, they currently have a market cap of $369 billion. In terms of the share price, though, shares are down roughly 10% the past 12 months, but down more than 15 or roughly 15% just in the past few weeks. This was a stock that was trading in the 425 area just a month ago and now sits around $370 per share. Of all the stocks that we're looking at here today, this is the one that comes with the most near-term risk. Again, all of these companies are going to be tied in some shape or form to the economy doing well, but especially the Home Depot. If the economy doesn't do well, if the labor force continues to weaken, builders are going to be slow to build, consumers are going to be slow to spend. But on the horizon, on the flip side, the real estate market has really been in a pit. And with interest rates starting to come down, this could be a pressure release valve for that industry as a whole. And if builders start building, assuming the economy stays together, this could be a huge benefit to the likes of the Home Depot. Looking here at this fiscal AI chart, we could see the EPS estimates for the next few years. And as you can see, a return to high single-digit growth. This comes after 2 to 3 years of negative to near zero growth for the company. And right now, shares trade at a forward PE of 22.5 times, which is just slightly below their historical average of 23 times. And when looking at the chart, we can see that the stock fell, again, nearly 15% from that mid-September high, and is in a downward trend with RSI sitting around 30. And the past few times we have seen that, the stock has rebounded. If a fall, though, does continue, I see that 355 to 350 area being the next level of support. In addition to upside potential in the stock, assuming the economy can hold together, the stock also pays a safe, reliable, and growing dividend, one that currently yields 2.5% with a 5-year dividend growth rate of nearly 10% and 15 consecutive years of dividend growth. This has been a prime example of a dividend growth stock. Analysts currently rate the stock a strong buy with an average 12-month price target of $447 per share, implying more than 20% upside from current levels. So there we just looked at 3 very different companies. 3 companies I believe 12, 24 months from now, you're going to look back and wish that we bought more of. And if you're interested in seeing my entire portfolio, then definitely head over to the Stock Investor's Edge. You can join our Discord community, all using that link down in the description below. Thanks again for joining. If you haven't done so, and if you found any value in this video, show your appreciation by just simply clicking that like button down below. And with that being said, we'll see you in the next one. Take care.